Ladies and gentlemen, good day and welcome to India Shelter Q3 FY26 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish Bhuba from ICICI Securities. Thank you, and over to you, sir.
Yeah, thank you, Shubham. Good morning, everyone. Welcome to India Shelter Q3 FY26 earnings call. On behalf of ICICI Securities, I would like to thank India Shelter management team for giving us the opportunity to host this call. Today, we have with us the entire top management team of India Shelter, represented by Mr. Rupinder Singh, MD and CEO, Mr. Ashish Gupta, CFO, and Mr. Rahul Rajagopalan, Head Investor Relations. I will now hand over the call to Mr. Rupinder for his opening remarks, and then we'll open the floor for Q&A. Over to you, sir.
Thank you, Renish bhai, and thank you, everyone. Good morning. On behalf of the company, I extend a warm welcome to all of you. Thank you for joining us on the call today. I'm pleased to share our Q3 and 9-month financial year 26 performance update, along with a brief overview of industry developments. During the quarter, the RBI announced a further 25 bps reduction in the repo rate, bringing it down to 5.25% with immediate effect. This takes the cumulative rate cuts in 2025 itself to 125 bps, making one of the most significant easing cycle in the recent years. We view this move as a clearly supportive of the financial service sector as we approach year-end. The latest rate cut builds on an early reduction and improves housing affordability, particularly in affordable and mid-income segments. Lower EMIs are expected to bring back hesitant buyers and helping sustain demand momentum. Lower financing costs, sustained buyer confidence, and steady macroeconomic conditions together place the housing market in a good position as we head into 2026 particularly. Moving on to the performance of the company, annual growth remains in the guided range with the gross managed assets growing at 31% to rupees 10,365 crores. In Q3 financial year 26, we disbursed 977 crores, registering a growth of 11% year-on-year. Assets and disbursement growth have been at a softer end as we continue to monitor the situation on the ground with respect to improvement in asset quality trends. Affordable housing market continues to remain robust as visible from early indicators like login rates, login quantities to grow month on month. In this quarter, we added 2 new branches. We will add another 4 to 5 branches in Q4 in line with our branch expansion strategy of 40-45 branches each year. Further, we have introduced digital sourcing as one of the additional channels. This will help us in advance our digital journey. Currently, around 4-5% of disbursements are coming from this digital channel, and going forward, our plan is to reach to 10% of disbursement. On asset quality metrics, gross stage 3 and net stage 3 came in at 1.5% and 1.2% as of 31st December 2025. On profitability metrics, profit after tax for the quarter came in at rupees 128 crores, registering a growth of 33% year-on-year and 5% quarter-on-quarter. Return on equity stood at 17.1%. Net worth now stands at rupees 3,048 crores, crossing the 3,000 crore mark. The PMAY 2.0 scheme saw further traction. As on December 25, more than 2,000 customers have already received the subsidy and journey looks continued and more effective now. The scheme is expected to pick up traction with an increase in customer awareness and streamlining of the process. On that, let me reiterate the guidance that we have provided earlier. Branch opening 40-45 for the year, of which we had already opened 35. Maintaining spread of more than 6% in the medium term. Credit cost for the year to be around 40-50 bps. Loan growth, which we projected 30-35%. Our intent is to close this year around 30%, though it was a muted year if we see the particular last 2 quarter of results. Now I would like to hand over call to Ashish ji, our CFO, to take you through the financial metrics. Over to you, Ashish bhai.
Thanks, Rupinder ji. Good morning, friends. Let me take you through key financial numbers. We have ended the Q3 with gross managed assets of 10,365 crore. Year-on-year growth is 31%. Quarter-on-quarter growth is 7%. Our portfolio yield is 14.9%, which is stable year-on-year basis. Our disbursement yield in Q3 was 14.6%. On funding side, we have diversified borrowing with more than 30 counterparties. Average borrowing tenor is about 8 years. Our bucket cost of fund is down by 20 basis point in Q3 to 8.3%. It is down by 50 basis point year-on-year basis. Our marginal cost of fund in Q3 is 8.1%, down by 70 basis year-on-year basis. We had undrawn sanction of 550 crore from NHB at the end of Q3. We have drawn two-thirds of the same in Q4, and we will draw the balance amount in Q1 next financial year. Cost of fund from NHB is lower by about 60 basis point as compared to the bank funding. Our lending margins at portfolio level and disbursement level are consistently above 6%, in line with our guidance for medium term. Net interest income for quarter is up by 31% year-on-year on the back of strong growth in our managed assets and improvement in spreads. Coming to OPEX, our year-on-year growth in YTD OPEX, excluding one-time impact of labor code, is 26%, which is lower than the growth in our managed assets. Same is resulting in better cost ratios. OPEX to managed assets without impact of labor code for the quarter is at 4%, down by 20 basis points year-on-year. On asset quality side, our stage 3 is at 1.5%. Our credit cost for 9 months is at 0.5%, in line with our guidance for medium term. PCR for stage 3 is stable at 25%. Our total ECL is 79 crore against the regulatory threshold of 48 crore. Our BT out rate is down by 4.3%. Our focused data-driven approach for customer retention is helping us to contain BT out even in declining interest rate scenario. PAT for the quarter without impact of labor code is at 128 crore, year-on-year up by 33%. ROA for the quarter is at 5.8%, up by 30 basis year-on-year basis. ROE for the quarter is at 17.1%, up by 200 basis point year-on-year. On liquidity side, we are comfortably placed with liquidity of 486 crore and undrawn sanction of 1300 crore plus. Our ALM is positive across all the buckets. With this, I conclude and we can open the floor for Q&A.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Varun Pancharla from Kotak Securities. Please go ahead.
Hi, sir. Hope I'm audible. I had a question regarding the asset quality metric. So, there's a sharp rise in gross stage 3 loans this quarter. Is there any pocket of stress that we're seeing, especially because our growth is slow in MP and Karnataka? Are those portfolios showing any stress? Second, last quarter you had highlighted that 85% of the NPAs get resolved through an agreement with the borrower instead of going for an auction, which leads to lower losses. Are we waiting for the resolution process and that's why the gross stage has increased, or has there been any change? And with regard to LAP versus home loan, is there any sharp difference in how the delinquencies are playing out over there? This is my question. You can.
Okay, fine. I'll start from the last question that you asked. Between HL and LAP, if you see, there's a stark difference. If we see our numbers, the NPA numbers for both LAP and HL remain same. It's in same range. In fact, there is a hardly a gap of 1 or 2 bits between the two. When we talk about if the geography per se, there is any particular geography where there's a challenge, I feel we have seen a certain trends which were happening in last couple of quarters. We were trying to hold it in a various buckets. But at a certain juncture, we realize it when the customer is not able to pay more than one EMI and creating a trouble at the last bucket of 60-90. So there was the only intent, which is basically either you get it rolled back or take a relief by ensuring that you can go for the next step of legal, action against that piece if it is not getting resolved. Unless until we move to the next bucket, the legal action doesn't come into force to that extent. Because SARFAESI, if it has to be enforced, it has to be only once the case crossed 90 NP. So this was not initial thought to have, basically. But seeing that, bucket is bulging at that time and customer is not pay back, I think then there is some harsh call which has been taken to let it go to the next level, basically. So that pressure starts coming up. If we see November month particularly has peaked out. November was at a certain level which has slightly come down in December. And yes, that trends continue to remain, in coming quarter looks so as we are forwarding it basically in this quarter itself. So I think now going forward we'll see the traction will come up after the action which we start taking November onwards on these set of accounts particularly. So it will take a couple of months to come on a table and settle it down, and very few will further continue to remain there till the time we possess the property. So this has been more like a thought where we have to not continue with that piece which is getting stuck at certain level and giving a more trouble in collecting and ensuring that it becomes stabilized. So we felt that it is a time to take it up, because quarter 4, if it become a bad, it would have been difficult for this quarter particularly. So that was a little on more on a actionable side that would take it up. So in fact, if we not have taken this plan, still it can have gone by maybe 10, 12, 15 bits. But with this action, it has gone back 25, 30 bits. So this was a thought on that. This is which we have taken action. Going forward, we feel the quarter 4 should definitely give a better result. As we see, we are almost 40 days in this quarter, and as we are seeing the result particularly. So I hope, and I'm sure that the effort, the team we are putting as such, will be able to get the result back that is expected by market as well as organization management, basically. If you talk about states particularly, you ask any particular geography, there are inch up in most of the geographies. I won't say that it's a one geography which is burnt out, which was the case 2 years back in MP. In fact, MP-NPA ratio is little improved by 5-7 bits compared to what it was 3 quarters back or 4 quarters back. But there's slight inching up across that piece which has impacted particularly. In every geography, there are at least 3-4 branches which are a little troublesome. There we are putting our impetus control through the business rule engine and scorecard mechanism, how to make sure that the things are getting tightening up. So this is the overall scenario on the ground, and this is the way that we're looking forward how to make sure that this remains under requirement of some 40-50 bits in terms of credit cost, and another reduction that we plan for the quarter 4, which should be back on the level of 1.2 or around 1.2, 1.3, somewhere between as we close the March number. I hope I answered your question.
Yes, those answer the question. And the NI growth, our interest income growth has been a bit lower than our overall AUM growth in that sense. Is this just that ending balance or ending the business was pushed a lot to end of the quarter, or has there been any lower yields or shift in mix that has impacted overall yield?
Basically, when situation is set on ground, we have to monitor and we have to put a lot of controls around that piece. So when we are putting it, keeping in mind that situation over market looks has to be little controllable instead of going the business at norm. So there's a dip of these 2-3% which has come up in terms of AUM growth, what normally used to have this, around 32-33%, it is hovering around 30%. So that is the impact altogether. But as we see after GST implementation, Diwali has also gone, as we see the December numbers picking up compared to the previous month's number, I feel this is going to keep building a momentum now. I would say now there are certain green shoots which are giving some kind of confidence that going forward you will find that traction on around that side. And this is the reason, though with the muted 2 quarters that happened in last couple of quarters, we feel that we should be able to come back in quarter 4 itself instead of waiting further.
Look, AUM growth quarter-on-quarter, if I look at it, is about 6%, but your interest income growth is only 4%. So it appears in terms of calculated yields, there's a decline. So has there been any reduction in yields that we have taken in terms of PLR cuts, or are the incremental rates that we are offering a bit lower than what we were doing earlier? Is there any impact of that?
So we try to maintain the spread which is more than 6%, and we maintaining the spread of 6.6%. Our cost of fund has also come, decently low, and this is something which we always keep mentioning, that as the cost of fund comes down, for the new acquisition of customer will definitely, pass on certain bits around that side. So where the cost of fund has come up from 8.8% to 8.3%, that piece has just come by around 20-25 bits what we were disbursing a 2 quarter or 3 quarters back, basically. So if we talk about disbursement yield for the quarter, it is 14.6. And if you talk about cost of borrowing for this piece, it is 8.2% somewhere, which is again maintaining what we expect around more than 6% of spread, and we continue to maintain that piece. And overall book size, that spread is anyway continue to remain the same range that we keep giving again.
Thank you. The next question comes from the line of Sonal Gandhi from Asian Market Securities. Please go ahead.
Hi. Thanks for the opportunity. So if you could just give us some sense on how is the 1+ DPD trending currently, and if you could, you've also mentioned that things kind of peaked out in November and December, on which is seeing better sense. So if you could just let us know what's the current, collection that we already ran the chat. And
1+ DPD remains. Yeah, Sonal.
Yeah, sorry.
I heard that you're talking about 1+ DPD trend basically. Am I right to hear that?
Yes. Yes, sir.
Yes. So 1+ DPD remains same. That is same range what it was, around 8.7, 8.8%. And there is no difference into 1+ DPD. Our challenge is always there. This kind of customer, when they moved into the higher bucket, bringing them back is actually takes a lot of time. And unless until we put a certain impact on legal side, the things become little difficult and start getting delayed. So if you talk about collection efficiency, that's also range bound the same level what it is happening say 3-4 quarters back. In fact, if you talk about collection efficiency in fresh bucket, that is even better than the previous one. Because the higher bucket where the customer is regularly bouncing, there the things are a little difficult. Because of that, we have taken this action. Otherwise, in the fresh bucket, the collection efficiency, there is no much difference around that. That remains same particularly.
And sir, any trend that you could give, between salaried and self-employed, or is it across, the customer cohort?
So our maximum customer is self-employed. More than 80% customer is self-employed. So the trend remains same for us basically. So no much difference between the two. That's the reason when someone asked me that how the GNPA behavior between HL and LAP. So there the behavior remains same for us. Not much of difference. Because people distinguish that HL is being taken by salaried employed and LAP is taken by self-employed. In our case, we didn't find much of the difference around that side. In fact, there is a dot-to-dot comparison between LAP and HL when you talk about NPAs of these two categories.
And sir, if you could just talk a bit about how the business is working. And
Sonal, not able to hear you. I think.
Sorry to interrupt, ma'am. Your voice is not clear.
Is my voice better now?
Yes.
Yeah.
Hello?
Yeah, Sonal, please.
Yes, sir. So just wanted to understand, if you could just give us some disbursement trend in January, and how do we see Q4 and FY27 panning out in terms of disbursement?
I mentioned that in November we peaked out in terms of delinquency, and obviously when there is a green shoot, that also give a trends after GST and things getting improved. December was much better than October, November, and September in fact. And as we move into new quarter, January, though it's a first month of the quarter, January is better than December. This is the indication which I can give it, right? So between October, November, December, if we see in October, November, we were around 310 crore of disbursement, whereas in December, we were around 355, 360 crore of disbursement. That was the thing which has come up, and January is better than that, basically. So we feel that way the quarter four coming up, and as we go into the next financial year, I don't think that there should be a challenge around that piece, because if things are settling down and we have also put our course correction that way, so it will give a good relief in the next year financial year, and we will remain in the same range bound of 30%, around 30%, 31% for the next financial year. That is our plan, that is our thought, which will keep working on, basically.
Thank you and all the best.
Thank you. The next question comes from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, good morning, Rupinder. I'm not sure if this question has been asked before. Just wanted to understand what is our guidance for disbursement as well as AUM growth for 27, and how do we split it between LAP and home loans? Also, have we done any exercise to understand what is the overlap of microfinance customers with our customers across LAP and home loans? Thanks.
So, actual to LAP ratio, which we always plan to do 60-40, that is going to remain the same way. And the factor between them, in our case, the behavior of the both side of customer, there is no much difference between the two. And as I don't know if Subhranshu were there or not, this was the question being asked by one of the analysts, and I mentioned that the NPA number in our case remains same between the both of them, these categories. So for us, there is no more differential. In fact, LAP is always a better in terms of giving a better yield around that side. So we are not going to change some trends around that piece. We continue to remain there, focus. That is one piece. And if we talk about microfinance piece, earlier it used to be around 5%. It is slowly coming down because we have also taken some proactive actions around that piece. When taking a bureau, if there's a microfinance company, we are a little more cautious around that side. So it's slightly dipping up. So you still assume that it is around 4 to 5% of microfinance piece, which is a part of our overall book, which may be LAP and HL both in that case particularly. So going forward, if we talk about our guidance on the loan growth, we feel this slight template which keeps coming as you keep growing it. But for next financial year particularly, we are targeting ourselves for 30% growth around on the AUM side.
30% on AUM and disbursement, how much?
So look, disbursement can move here and there basically, because you have to keep in mind the trends, how is impacting the market, what is the situation. There's a seasonal factors also. But yes, we will reach there. What is more important? Our major prerogative is by 2030 to reach a 30,000 crore of AUM, which will be there basically. So that thing is very well in line, and we don't see that we have to deviate from that in the current set of scenario. That is our very clear thought.
Understood. And if I can just ask one last question, what is the FOIR that we maintain in our HL and LAP at origination?
So FI, both products for us also remain same because it's a self-employed customer. We don't differentiate that way. So 50 to 55% of FIR is there in both of the categories. What is the differential between the two is the LTVs. On the LTV side, home loan is around 55-57% and LAP is around 47-48%. That is the point of difference between us.
Understood. Thank you so much. This was really helpful. I'll come back in the queue.
Thank you. The next question comes from the line of Aditya Pal from MSA Capital Partners. Please go ahead.
Hi. Thank you so much for the opportunity. Good set of numbers. A lot of my questions have already been answered, but just wanted some nuances on the collection efficiency in the DPD book. So now we've seen a 30 basis points increase in NPA, and we've also seen a 30 basis points increase in our 30 plus DPD. You've already answered that there's no geographical or product nuances, but if I were to look at from a month on board nuances, which are those vintages that are not behaving well for us?
If we see on the fresh side, our collection efficiency is in fact improving. We see the quarter 1 to quarter 3 or quarter 2 to quarter 3. In the fresh side, there's a slight improvement, basically. Right? this is a point which is giving us confidence to convey a message that now things look little more improved. We try to curtail this piece, and that's why quarter one, quarter two remain muted at 1.2%. But we realize that since this 30 plus is moving on, and that is creating a good pressure on entire system. So it's a point that you have to take a certain call either to allow it to move or, bring it back. Bringing back was finding it a little difficult because customer is very clear that one EMI you can take but not beyond that piece. That was always we finding a challenge. And at one point of time, we didn't have a choice but to raise the bar to let it move out, out of this funnel and let's act around that side. So this was the point particularly. If we see typically efficiency which remains between 98-99%, there is no much change around that piece.
No. So my question is more to do, I understand that what is the situation now, it is a macro situation, that also I understand, and you all will come outside of it, that also I understand. But I'm just trying to understand, is there a particular book that we would have raised maybe say 18-24 months back that particular cohort of customers are not behaving well? That is what I'm trying to understand.
So more than a cohort, we have realized that the ticket size where the impact is more than the cohort. So lower ticket size has definitely a more impact than the average ticket size of which is 10-15 lakhs basically. So if we see the buckets of 1 to 5, 5 to 10, 10 to 15 and 15 and above, obviously our range is anywhere majorly around 10 lakhs. So up to 5 lakhs has definitely a little more problem in terms of increasing delinquency particularly. If you talk about cohort on the basis of MOBs, then there is no much difference around that piece. Definitely, the first 12 months, the cohort looks very, very different, and it looks very positive picture. So, but the cohort between 18 to 24 or 24 to 30, there is not much of a difference between the two.
Understood. So there's no particular behavioral differences that should be called out between the cohorts.
So that is maximum ticket size, what I mentioned basically. There you find definitely a difference between the two.
Understood. So and also now that we know that there is a structural issue going on in the sub 5 lakhs, or I would even say that sub 10 lakhs, do we see our average ticket size moving upwards from 10 lakhs going towards say maybe 12 to 13 lakhs in the next 2 to 3 years?
So we will put curves which we can improve the quality there. Basically, when you have a certain set of customer in that particular cohort, you also go dip check how we can improve there basically. So in this category of cohort, we will improve the scorecard score a little higher. DRE will work in that effectiveness. It is not that we are going to leave this customer. This is a customer which gives a very good yield also. This is a customer which also, when you talk about most of the customers bring almost 200 bits of advantage compared to the rest of the customers. So instead of leaving that cohort entirely or something like that, we will be a little more choosy and keeping sure that, we maintain the scorecard model at the best of prudency around that side. So that will be the action that we will take, which we already started a couple of months back.
Understood. Just one last question before I come back in the queue. Sir, you mentioned that you're seeing a good turnaround in Jan and December exit, and you're calling November to be the asset quality peak in terms of the worsening impact. But I'm just trying to understand that what gives us the comfort that we are seeing the turn. Is it a momentary turn or is it a structural turn on the ground? Because a lot of people had called that the credit cycle has turned a couple of quarters back. But it's evidently so it is not the case. There are a lot of asset quality issues panning out in other companies' balance sheets. So just trying to understand that what gives us that this is a structural turn and this is here to stay now.
So if you see, there is always a matter of timing for whatever, how you control it. We were always very hard and sure that we have to make sure that these are remain controlled and the intensity of collections, follow-up, that remains strong across basically. We didn't wait for that even 2 quarters back. But we realized that which is bulging out, there is no point of holding it and ensuring a coming pressure on us. That way, release it. That is one piece. Secondly, what gives you confidence? Even in fresh efficiency, we said a certain improvement which is coming, basically. That gives us confidence. Plus, when we do the analysis of a login particularly, the percentage of logins which were coming earlier at a bad score is now coming down. Now it is logins which are coming at little improved and better scores. And if your login is improving to that extent, automatically that output is also going to improve accordingly. So these are the 2-3 parameters which give you some bit check around before thinking about it. And anyway, we have not changed the BRE rule. In fact, for the month of December or something, that remains same. So for us, it is a situation where if you are logging 100 files and out of 100, 50 were coming bad and getting rejected. Today that 50 is coming down automatically by virtue of selection to the level of 40, 45. And that's the improvement which is coming up accordingly.
Understood. Makes sense. Wishing you and the team all the very best. Thank you so much for answering all my questions.
Thank you.
Thank you. The next question comes from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi, sir. So, few questions. Firstly, on the overall now PD assumption, you mentioned that there have been challenges in terms of pulling back from maybe the higher bucket. So would that eventually lead to some kind of a change in PD assumption and a slightly higher stage 2 provisioning compared to where we are currently at 3.4 odd %? Would that happen with this kind of a challenge which is coming up?
So, so the overall ECL front, if you look at the PD calculations, so PD calculation, one factor is that obviously historical trend, and another factor is macroeconomic overlays that we apply to that. So if you look at the macroeconomic overlay that we apply to our PD is the interest rate. So our PD has an inverse correlationship with the overall interest rate environment. If the interest rate goes down, PD slightly goes up, and that we have seen historically during during demonetization, during COVID, GST cycles, and all that. So as the interest rate cycle is coming down, our ECL model is throwing slightly higher PD, which is getting factored in our overall ECL provisions that we are making.
Okay, but incrementally this trend which was reflected in terms of GS3, that wouldn't change much in terms of our PD assumption.
So, if you look at the overall LGD model, so our actual LGDs are, close to 11-12%, while, overlay is close to 25%. So stage 3 will not be reflecting the, actual LGD which is there on the ground. It is because it is with a management overlay that is there.
Okay, got it. And secondly, with respect to employees, so almost 400 odd employees addition during the quarter. So is it more of upfronting, or we have strengthened the collection infrastructure? What is happening? Is it more on the collection side? We have added more people?
Yes, these people largely start coming from quarter 2 onwards. And, as time progresses, we also realize that that's an important thing that we have to be always, preemptive on these kind of actions. So most of the people joined majorly into the collection field if we talk about 2 particular quarters. Yes, there were certain other departments where the people joined. For them, it's like, as per the plan that we planned for the year particularly. But additional resource on the higher side, which we'll realize that's more on the collection in the field particularly.
So almost like 200, 250 people who have got added on to collections?
Approximately 200 plus, yes.
200 plus. Okay, got it. And lastly, maybe on the previous question, whether you have actually changed or tweaked the lending rates. I understand in terms of your guidance on spread of 6% plus, but any revision to lending rates either on home loan and LAP for existing or for incremental loans that you have done? Hello?
Am I audible?
Yes, sir.
Yeah. So, point is, we keep mentioning that if we are getting a benefit rate for the new acquisition, since our most of the book is fixed particularly, for new acquisition, we're going to give certain rate benefit to the customer. So, our lending rate is coming down, which has done thanks to, what happened in last 1 year in terms of a rate cut. So, we are fast for acquisition of new set of customers. Again, between the two, home loan and LAP, home loan definitely get a little more advantage around that side particularly. So that is where we're going to pass on, and that is the reason which we used to disburse at 14.8, 14.9 earlier. That has come down to 14.6% in average.
And even if you see that, our cost of fund, which is the marginal cost of fund, is at 8.1%. So incrementally, we are onboarding about 6.5% spread on the fresh disbursement. So we are not diluting on the spread.
No, that I understand in terms of we are not compromising on spreads. But just wanted to check, so we would have revised the lending rates by 25-30 basis points till date, and any further rate cuts, maybe obviously if you get the further advantage on the funding cost side, you might further tweak it. But on existing, there is no change. Only on incremental, we have done by 25-30. So is that the fair assumption?
Fixed rate of books, and that is not even required in that case.
Yeah. Oh, okay, got it.
Thank you. The next question comes from the line of Mayank Mistry from Antique Stock Broking. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Am I audible?
Yes, you are.
Yeah. So, sir, my question is mostly on a long-term view. Now, today, if you look at our peers who are, having a size of around more than 13,000 crores, their growth has slowed down to 25% around. So, should we consider the same in your case, or should we see it like a more scalable, and sustainable model of 30% AUM growth? That's one. And secondly, what are you planning on the geographical expansion side? We are present right now in 15 states. So any expansion plans there? And just last question on the OPEX side. So our OPEX to AM is ranging around 4.2% today. What are the efforts we are taking, to improve this? Thanks.
So on the OPEX side, as you have seen that gradually, every year we are adding about 40-45 odd branches, and the proportion of new branches that are coming is gradually reducing. So that will help us bringing down the overall OPEX ratio. And secondly, as we have mentioned in the very initial commentary, that we are focusing on digital sourcing of leads now. So as of now, about 4 to 5% of our leads are coming by way of digital means, and we are looking forward to increase this proportion to about 10-12% from here. So this will further help us to bring down the overall OPEX. So we feel that in terms of overall OPEX to AUM ratio, we will continue with our guidance of 15 to 20 basis point reduction year-on-year basis from here as well.
And anyway, adding to 40-45 branches remains same. That will be the plan. Last year, in one of the investor day presentation, we mentioned to investor body that our plan is to take it to AUM at 30,000 crore by 2030. That again remains same. And adding 40-45 branches, there will be no change around that side. That is also remains same. These are the total, typically long-term strategy which you're talking about particularly. And on the OPEX side, yes, 15-20 bits, as Ashiji mentioned, that is the progressive going forward. And we're taking the necessary steps that keep improving it around.
In terms of state-wise geographical we are already there in 15 states, which contribute about more than 90% of the total housing finance market. So at this point of time in the medium term, we are not looking to add any further states.
Correct.
Okay, sir. Thank you. Thank you so much.
Thank you. The next question comes from the line of Bunty Chawla from ASK. Please go ahead.
Yeah, thank you, sir. Thank you for giving me the opportunity. Just one clarification. You said gross NPA should decline in Q4 to 1.4% versus 1.5%. Is it right?
I think we are more optimistic. But
okay.
I think the baseline is we are more optimistic.
Okay, so on that basis, what should be the credit cost? Because as we have seen, the credit cost has inched up in Q3 versus Q2. So how one should see the Q4 credit cost?
So that will be again as per our guidance. It is going to remain around 50 bits, 40 to 50 bits somewhere between.
Okay,
So
that was for okay.
For the year.
For the year.
Okay, so that's remain same for FY27 as well.
Yes, that's the focus. In fact, that is the focus. You're right. I think there's no point of giving a very long haul deeper on that side. Yeah, correct.
Right. So, secondly, on the disbursement, as you have slightly given the throughput by improvement in December and January, but if I see if we are still sticking to 30% AUM growth, so it seems to be a tall task in Q4 disbursement of 30% plus kind of a growth on a YOY basis. So are you still confident that we will be able to achieve seeing the run rate in December as well as in the January?
Quarter 2, quarter 3 largely was muted, if you say. In quarter 3, only the traction starts coming in month of December, right?
Yes.
And as it is December, January is again, I am giving you some indication that has improved further. Basically, that is giving a confidence that this should now coming to the situation that is as per the expectation. So we are expecting, 30%, 31%, 29%. It should not be beyond that piece because we just completed the month of January. But that looks more clearer now as we are progressing, basically.
Okay. And one data point clarification.
I'll not be in position because we just completed January. But as we see the login trends coming in first few days of February, that is also giving a good positive indication.
Okay. That was very helpful, sir. Just a data point comparison, what we were seeing 30 DPD plus, it seems to be stage 2 plus stage 3 coming towards 30 plus DPD. But if I see the increment or I add both the two, it's come to 5.2% versus you have reported 5%. Is calculation something I'm missing in this part?
So, during the COVID period, so we have restructured about 1% of the total portfolio at that point of time. And as per the RBI guidelines and the ECL methodology, we have classified the entire portfolio into stage 2 category. So the DPD may be like 0 DPD, 1 DPD. So that's why, that portfolio is still, still running on the balance sheet, and overall exposure to that restructured assets is about 0.15% of the total AUM. So if you add the 30 plus as well as this 0.15, you will get the similar number.
Okay. That is the calculation. I understood that. But lastly, from my side, provision coverage ratio, which has slightly increased from 24.6 to 25% on a sustainable run rate for FY27, what should be the provision coverage ratio we should assume for stage 3?
So stage 3 provision coverage ratio is like pretty much consistent in last 2 to 3 years that we have seen.
Yes.
It's our historical trend, and it will continue in a similar direction of about 24-25%.
Okay. That was very helpful, sir. Thank you and best of luck, sir.
Thank you. The next question comes from the line of Meghna Luthra from InCred Equities. Please go ahead.
Hi, am I audible?
Yes, ma'am.
Yeah, Meghna, go on.
Hi, thank you for the opportunity, sir. So I just wanted to understand how has our login to sanction ratio and a sanction to disbursement ratio moved from November and say in January or February, since we are seeing an improvement?
So earlier the login to sanction ratio fall drastically down because BRE was, curtailing most of this customer, whichever bad bureau score, what BRE picks up basically, as per the rules set there particularly. Mm-hmm. But I think with time, two things has happened. One, behavior of customer improving as, economy terms, things are looking little better on that side. That giving some kind of traction. Mm-hmm. So you can see slight improvement around that side. So which was following month on month has now stood up in month of December, and slight improvement has come in month of January. So that is what we can see that piece. So login to sanction ratio, which fall down to the level of say 45%, is coming back to around 50% back.
Okay. And sanction to disbursement ratio, sir? How would that be?
Sanction to disbursement ratio for us is around 70%. So that keeps moving 70-71% because main challenge is always getting a right sanction basically, right? And sanction at the time of disbursement, most of the customer, sometimes they could not finalize the property, or sometimes they change their, plan of getting a loan or something. That keeps happening around. But that is 70-71, which is more or less consistent across the 10 years.
Understood. And sir, you mentioned that we will be increasing our digital sourcing. So can you highlight how are we working around that?
So we have set up a in-house digital team at the head office with the senior leader on that side, who is expert into, getting a leads by social media impact and various alternates which can give a quality leads. So that brings a better control and a driver on that side. So we started this activity a few quarters back, but what we are realizing now, it starts picking up because some initial days it was more on setting up the entire system process around that side. And now these are a set of leads which are, start building up and the conversions there itself also start improving basically. So typically last quarter it has contributed around 4-5% with us. And what we feel, the way the pipeline is getting built up, I think in couple of quarters we should be touching around 9-10%, which is coming on that piece. So this will give more boost in terms of, improvement in productivity of employees on the field. That is one piece. And momentum into business side also in one way or other way. So this is something that we set up. So we are a team of around 40-50 people who are totally dedicated on across country. And this is a purely in-house sourcing.
Okay, got it. That's it. And lastly, sir, a little on the macro front. What would be our PMAY contribution and how is it that we are moving with the PMAY side?
So in PMAY, in last PMAY schemes got implemented last year in October. Few quarters, majorly for the system improvement both side by MOHUA and company side, that took toll and time around that side. But it starts picking somewhere at the end of quarter one. And if we see the last two quarters, quarter two, quarter three, it has actually picked up well. And in both of the quarters, we have disbursed more than 500, 600 customers each in a quarter. And today, we have more than 2,000 customers where we have funded PMAY. And this pipeline is building up. The message is going on the ground. And those technicalities which are always a hiccup around that is also start getting eased out. There are more for the scope around that piece, which I think MOHUA is well committed. And I think shortly they should be able to solve those problems in terms of technicalities. And I think it should continue. It should give some better traction as we move into the new financial year.
Got it. Those are my questions. Thank you.
Thank you. The next question comes from the line of Lalitabh Srivastava from iCheck PMS. Please go ahead.
Yeah, hello sir. Thanks for giving me the opportunity. Just wanted to understand, sir, in the current scenario where it seems that the rate cut cycle might have, bottomed out, what is your outlook on the cost of funds and the margins going forward? And would you, it seems that our overall GSC has slightly been inching up. What is our assessment of the situation and how? What is your outlook on the normalization on the asset quality? Those are the questions.
So, like on the overall cost of fund side, say if you see, our bucket cost of fund is at about 8.3%, while our marginal cost of fund is 8.1%. So, though we have seen, about 50 basis point reduction in the last 12-month period, but still, our cost of fund is slightly higher than our peer. And this is purely a, function of the scale as well as credit rating that we have currently. So, we feel that this is our FY26 financial results. We will be approaching to the rating agencies for a rating upgrade, and we feel that if we get a rating upgrade, there will be a scope of further reduction in the cost of fund from here by about 20 basis point. So we are looking forward to that. Hopefully, the overall financial performance is justifying a rating upgrade. We'll look forward to the favor of rating agencies as well.
So, just to understand it better, sir, assuming that there is still some time for us to get that rating upgrade, what is the outlook that you have on, the margins for, say, FY27?
So if you see that, say like our marginal cost of fund is at about 8.1% and bucket cost is 8.3%. So even if we, go on that particular pace, there is a scope of improvement in spread by, improvement in cost of fund by about 10 to 15 basis point in next 3 to 6 month kind of period. So as you have seen that we are already on the fresh disbursement, we are onboarding a spread of about 6.5%. We feel that we will continue to do the same over this current interest rate cycle.
Yeah, okay, sir. And maybe, on the asset quality and the growth outlook, sir. Thanks.
So on the stage 3 asset, as we have said that, the stage 3 asset have largely peaked out in the month of November. And in December and January, we have seen some positive improvement in that. We feel that by end of Q4, we should be again bringing it back. May not be like to the normal level of 1%, but close to 1.3, 1.4%.
And what is our assessment of, how things should pan out in FY27 in terms of asset quality? What are the normalized or levels that we are looking for 27?
We normally take a target of around 1.2, 1.25. That is the target we normally take, which we drive it basically. So I think that is not going to change for the next financial year 27 also for us.
Okay. Thanks a lot for taking it.
Thank you. The next question comes from the line of Aman Soni from Invest Analytics Advisory. Please go ahead.
Hello, am I audible?
Yes.
So we have observed that the company's GNP has increased from 1.2 to 1.5, and NNPA has risen from 0.9 to 1.2 during the same period. Could you please explain the primary reasons behind the increase at a group level? Are customers facing any specific repayment challenges or stress that is leading to higher delinquencies?
So I think you have seen the trends which were in market in typically last 1 year. There's a challenging market, and typically for the segment of customer we deal into, there is always some heat around that side, which we also find out that the customer even moving to next bucket, which is taking a lot of time to come back to for the normality position. Because in this scenario, giving 2 EMIs or more than 2 EMIs was a little challenge around that piece. So that is a typical challenge. Though on the fresh side, the collection efficiency remains intact particularly, but the way the behavior was say 1 year or 2 years back, where the customer is moved to the next bucket, can easily come back to the bucket 1 with a little effort around that piece. That is not a scenario as of now in the tough situation which the market was facing. So that's why once it moved into this bucket, it was getting gold and stuck around that side. So we have an option either to bring it back or to take some legal course action around that side so that, we neutralize it or we sterilize this kind of situation particularly. So we try to tweak between the two. And here, instead of allowing only sitting at there and that bucket keep bulging it, we took this decision to flow little 20-30 bips around that piece. And now action also starts happening around that piece particularly. And as we see, I think we'll be able to get the result out, what is expected from this kind of situation particularly.
Understood, sir. Thank you. That's from my side.
Thank you. The next question comes from the line of Aditya Pal from MSA Capital Partners. Please go ahead.
Hello, am I audible?
Yes.
Yeah, thank you so much for the opportunity. Thank you so much for taking up my follow-up. Just one bookkeeping question, sir. If you can help me, over the last 4 quarters, how have the attrition rate trends been for us, and if you can call out certain geographies where there are anomalies that you're facing?
So attrition we normally split into 2 pieces. One is a regrettable and one is a non-regrettable attrition. So non-regrettable attrition
I'm on the branch attrition.
So branch attrition is around 35% for us basically, which is recorded. 35, 34.8, that keep hovering quarter to quarter basically. This is a range bound particularly. And that remains almost same level basically. Every quarter you'll find a gap of, 0.5, 1% here and there. Some quarter you'll find it's coming to 34.5, some quarter maybe 35.5, 36%. No drastic change around that piece. And that's a process which is running from now multiple quarters around that side.
And any geographical nuance to that certain geographies have higher attrition, certain geographies have low attrition. The geographies that are having low attrition, what is the attribute that they have low attrition? Something of this kind.
Geographies which have a more vintage, definitely the attrition is low because employees get very well set into the system. They understand process, technology very well, and that gives them boost and their productivity starts building around that piece. And that can happen in any of the geographies with the vintage branch particularly. Where the vintage of branch is new, and the young guys, they feel that they're not getting set into that piece, then they like to move on basically. And here also, as you start a new branch, there is always a focus and drive on the productivity to meet the parameters of the existing one. So definitely those parameters also try to put a more drive and easily curve between regrettable and non-regrettable there. And accordingly, the non-regrettable, start, moving out earlier than the other one because there the vintage and scope, they definitely support employees to continue with us basically.
Understood. And the Madhya Pradesh branch that last year that our team had moved out, it has now come up and performing well, and the asset quality issues that we were facing over there has been completely cleaned.
It has not completely cleaned. Otherwise, I think the number would have been a little more better. But yes, compared to last year, whereas rest of the geographies have gone up, Madhya Pradesh is the exception where that remains same, and even in month of December, they reduced by some 10 bits basically around that side. But yes, for complete cleaning, I think will take some more time, for which I think teams are on the job.
Perfect. Wishing you all the very best. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments. Thank you, and over to you, sir.
Thank you, everyone, for taking your valuable time for attending our earnings call. An audio recording and the transcript of this call will be uploaded on our website in the due course. Looking forward to hosting you all in the next quarter. If you have any questions or query or require any additional information, please feel free to reach us out. Thank you so much and a great day. Thank you.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.